Hello everyone, hope you guys are well. Today we'll be discussing about different types of investing strategies. Hope you guys are excited and let's jump right into today's presentation. Investing strategies. Here's the table of contents for today. We're going to be discussing what risk is, what a brokerage is, the different types of investing strategies, and we're going to be concluding. Let's first talk about what risk is. Risk is the chance that an outcome or investment's actual gains will differ from an expected outcome or return. The more riskier an investment is, like cryptocurrency, the higher the return is to compensate for taking on that risk. Low risk investments, such as treasury bonds, are usually more predictable with less volatile swings. Think of risk as how much an investment bounces around at different prices. So let's take a look at the graph on the right side. We have one line and one curve. Which one would represent the treasury bond and which one would represent cryptocurrency? So, assuming that you guys have the answers, the pink line has a constant slope. And because it's predictable and consistent, this would represent the treasury bonds. Whereas the blue curve, it's volatile, meaning it's swinging and unpredictable. This would represent something like cryptocurrency, so a more riskier asset. Examples of risk in our daily lives include driving, walking down the street, or even negotiating with our bosses on our salary. We all have a distinct risk profile which determines our ability and willingness to withstand risk. And the main determinant influencing our risk assessment and risk management is time horizon. Time horizon refers to the length of time which you can part with your money before needing it again. The longer your time horizon, the longer you can wait out any large dips to have more riskier investments. And if you have a shorter time horizon, you might be forced to withdraw at a dip. The shorter time you have, the less risk you can take. So if we go back to this example, I don't know if you could see my cursor, but let's start out on the blue curve. And let's say our time horizon is low. Then, maybe in the middle, do you see the little down curve? That's where we might have to exit our position. So taking it as a loss. Whereas if we had a longer time position, let's say maybe 5 to 10 years, and then we could withdraw at points that are above the curve or take less losses. So the key point here is that if you have a longer time horizon, you are able to take on more risks. And younger investors usually have longer time horizons, which means that they have the advantage of being able to take higher risk investments with higher potential returns. And this also allows to create generation wealth, which requires time and consistency. Next, let's discuss the two types of financial risks that investors are exposed to. So first, we have the systematic risk, also known as the market risk. These are the risks that affect an entire economic market overall or a large percentage of the total market. Market risk is the risk of losing investments due to factors such as political and macroeconomic risk that affects performance of the overall stock market. So think of systematic risk as things that are not within your control on a macro level. So examples of systematic risk include changes in interest rates, war, inflation, and high rate of poverty. Next, we have the unsystematic risk. This is also called the idiosyncratic risk. Idiosyncratic just means distinctive, which only affects industry or particular companies. And examples include change in management, regulatory change in impacting company sales, and a new competitor disrupting the marketplace by taking away market share. And I forgot to mention that in systematic risk, this risk cannot be mitigated by portfolio diversification, but it could be reduced with asset allocation. So putting your money into different assets. Whereas unsystematic risk, you could mitigate or reduce the risk by expanding your diversification. And this is something more within your control. Now, let's talk about brokerages. What is a brokerage? A brokerage just means businesses or service that acts as a broker. Examples of brokerages include Fidelity, M1 Finance, Charles Schwab, Vanguard, and even Coinbase if we're talking about crypto. And I use the word broker and brokerage. So what does a broker mean? A brokerage? A broker and an individual or a broker is an individual or firm acting as an intermediary between an investor and a securities exchange. The reason why brokers exist is that securities exchange accepts orders from individuals or firms who are members of that exchange. So to simplify, brokerages broker transactions. Just like how realtors broker transactions between a buyer and a seller, the brokerage allows you to buy and sell stocks. Brokers are usually compensated through commissions or fees through being paid by the exchange itself. So as an investor, you always want to look for brokerages that keep costs low and offers tools to analyze your own portfolio. Personally, I've been using M1 Finance for the past 2 years, and I really like the design as well as their auto invest tool with their elegant pie design of my holdings. Now let's talk about the different types of investing strategies. We'll be looking at the 3 different dimensions, which are management style, progress style, and size. So, first, we have active versus passive management. Active management involves a professional manager or a team of professionals who track the performance of an investment portfolio and make buy, hold, and sell decisions about the assets in it. Active managers rely on investment analysis, research, forecasts, quantitative tools, and experience to make decisions on which assets to buy and sell. Passive management, on the other side, is associated with mutual and exchange traded funds, where a fund's portfolio mirrors a market index. So the passive management style is also referred to an index investing or passive investing. Passive management follows the efficient market hypothesis, which demonstrates that no active manager can beat the market for long, as their success is correlated with chance. Since we now know the different styles of management, let's look at the returns in history. So from 1987 to 2021, the performance of active and passive management has been cyclical, with each style trading periods of outperformance. Another insight that studies have found was that active management typically outperform passive management during market corrections, as active managers have captured more upside as a market recovers. But overall, it was found that there was no clear winner in active versus passive large cap funds. And Morningstar reported that out of 3,000 active funds, only 47% survived and outperformed their average passive counterparts in the 12 months through June 2021. Although passive management has outperformed active management recently, the past performance doesn't guarantee future results. Now, I wanted to bring this up because there's usually a lot of news talking about which strategy is better, and I also fell into looking at the recent results. Instead of following at the recent performance to enchant your chase to returns, we should really consider the current market conditions and what the future could possibly hold. This means that we are considering how equity prices have risen in the past decades, looking at the historical averages of different sectors, and even thinking in just broader perspectives as a whole. And I'll leave this picture where I got this source in the description down below. It was from Morningstar as well as Hartford Funds and CNBC's report. Now, on to the second dimension, growth versus value. What is growth investing? It's a style focused on increasing investors' capital. As clear as that. It is primarily focused on riskier, higher earning companies such as small cap and startups that grow much faster than the overall industry or mature companies. Some of the examples include buying into Google, Tesla, and Amazon based upon their focus on investing in innovative technologies, their sales growth, and expansion into new businesses. Whereas value investing is a strategy involving picking stocks that appear to be trading less than their intrinsic or book value. This is really important. Trading less than their intrinsic or book value. So what is intrinsic value? What is book value? Intrinsic value is a measure of what an asset is worth determined by qualitative, quantitative, and perceptual factors. whereas book value is the accounting value of companies' assets minus liabilities. So value investing is like knowing the ins and outs of a hardware and being able to save a lot of money by getting it on sale. So let's say you're trying to buy a used car and you know the ins and outs of the market. You know which model it is, how the relative price of this certain car, and you're able to get it cheaply because you know where to get it and you know the true value of that used car. I hope that paints a clearer picture of what intrinsic value is. Value investors also use financial analysis, ignore trends, and view long-term qualities of companies. And they evaluate intrinsic value of a company by studying their financial performance, revenue, earnings, cash flow, as well as profits. This is the long-term strategy to own a percentage of a company. And it's also followed by Warren Buffett, which he learned from his teacher Benjamin Graham, allowing him to amass great wealth. Next, let's talk about small cap versus large companies. So, what is small cap? What is cap? Cap refers to the market capitalization or a measurement of a company's size. Capitalization is number of shares of a stock of a company that has outstanding multiplied by the share price. So if we take an example, let's say Apple has 16.5 billion shares. And if we multiply this by the share price, which is currently $170 as of April 9th, 2022, we get $2.8 trillion. And Apple is currently the largest market cap company. $2.8 trillion. That's just mind-blowing. And small cap is a public company whose total market cap is about $300 million to $2 billion. The exact figure varies, and investors interested in small cap companies are looking for the next large cap for the future. Small cap historically has outperformed large cap stocks, but are also more volatile and riskier. Remember how earlier we talked about the more volatility there is in a certain investment, the more rewards you get. This is a perfect example. Large cap refers to a company with a market cap of more than $10 billion. Now, this number varies, but it's the range which is commonly used in the financial industry. And large cap stock represents 98.5% of the total US equities market, which consists of companies with a minimum of $25 million float adjusted market cap. And if you guys don't know float adjusted, it just means the index counting shares available to investors only, excluding shares held by companies or governments. So it's the money that is not a part of the company's holdings or the government. Large cap stocks have been associated with being transparent, good dividend payers, and stable. Think about it. All small cap companies have grown into large caps. And the characteristics, again, include transparency, which means that the public has access to information, they're good dividend payers, and relatively stable, continued and sustained earnings. Some of the examples of large cap companies include Walmart, Amazon, and Tesla. Now, on to conclusion. Before choosing an investment strategy, it's essential that you figure out where you are in life and evaluate your time preference. What's the primary purpose of your money? What are you trying to accomplish? Think about your short-term goals, which are usually less than 5 years in the future. Then think about your intermediate goals, which are 5 to 10 years in the future. Last but not least, let's think about the long term, which is more than 10 years into the future. Is it to take care of your loved one, possibly your spouse, for better opportunities, to buy a house? Whatever it may be, make sure that you have a clear time horizon in order to figure out the correct asset allocation. And no matter where you are in life and how behind you might feel, don't compare yourself with others, as there is no better time than now. Utilize the time you have now to make your goals become reality and mold your visions. Remember that if you have a shorter time horizon, the less fixed income you want to stabilize returns, whereas if you have a longer time horizon, you want more equity. There's trade-off of returns and risk, which all matters based upon your perspective and your time horizon. And once you have figured out your time preference, pick a broker with low commission cost and fees in general. Then execute. Repeat the strategy you have picked and stick with it. Consistency is key here, and you need to be disciplined to practice the ritual to accomplish your goals. Nobody will get it done for you. Remember that. And I'd like to end with a quote from Warren Buffett. Successful investing takes time, discipline, and patience. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. By Warren Buffett. Hope you guys enjoyed today's presentation about discussing different investment strategies, and hope you guys implement some of these if you guys haven't already. And if you guys are already implementing it, I hope this was a great reminder to assess our risk tolerance, our time preference, and figuring out which strategy works the best for us. We're creatures that are very great at utilizing tools, and it's a necessity for us to create and get to our goals. I think there's no better way than ending off there. Thank you guys for your patience, your curiosity, and I'll talk to you guys real soon. Peace.